Good day, Inderes TV viewers and listeners. I'm Verneri Pulkkinen. I'm working at Inderes as community manager and policy. In this presentation, I'm giving you a glance at the stock market. But in the beginning, I'd like to remind you we have 3 interesting company presentations following after this presentation, and you can ask questions from the company. So please write your questions below. Let's go to the actual presentation. This year has been a year of artificial intelligence. That bull in my presentation is actually made with artificial intelligence at Adobe Photoshop, so it fits well in this theme. And it also describes the bullish theme in my presentation. At first, a bit provocative slide. I think this is the easiest time in recent memory to invest. Maybe not in the whole history, but in recent memory. For example, you get risk-free rates. From the US 10-year bond, you get 4%. From German Bund, a bit more than 2%. Inflation-secured securities in the US, they provide you 2% per year. Maybe not much, but much better than, let's say, a few years ago. European high yield, 8%, or dividend yield at Helsinki Stock Exchange over 5%. For European stocks, on average, you only have to pay around 12 times their earnings. So that's not too bad. Investing is a lot easier than a few years ago when you had to pay perhaps too much for many equities. Also, dividend investing, which is quite popular in Finland, has become very easy. We have around 40 companies in the stock exchange that provides you a dividend yield of 5% or more. Of course, dividend, it's only about moving money from company account to the owner's account, but still for some owners it's very important. And you get a 9% dividend yield, for example, from Nordea, or almost 9% from Mandatum. So it's quite easy to pick very high dividend yields at this environment. As I said in the beginning, the theme of the year has been artificial intelligence. Even though mostly globally stock markets have been in a bull market since last autumn, especially this year, a few stocks only has gone up, like the Magnificent Seven group, which consists of Microsoft, Apple, Tesla, and so on. And if we look at the rest of the world, it has gone sideways for most of the year. Some people have been criticizing that those big companies are in a bubble, but actually market concentration is quite normal. Here you can see a history of the top 10 most valuable companies in the United States. And as you can see in the left-hand side, there's been Exxon, General Electric, or General Motors, and every one of those has been the biggest company for many decades. We don't know how long Microsoft will be one of the largest companies, or Apple, but if history is any guide, they might be there for some decades in the future. But of course, we also have to remember, for example, Kodak, that was a leading company in the 1970s until it disappeared in a very short notice. Regarding Helsinki Stock Exchange, this has been a rough year. It's been a rough few years in the stock exchange. Here you can see our small cap index dividends reinvested. It has been a remarkable bubble, and now the stocks have almost halved from the top in 2021. If we look at the 25 biggest companies, they have decreased around 20% with dividends, and if you adjust also for inflation. So I could say that investors' earnings power has not gone up in the last few years. But on the other hand, despite these few last years that has been terrible, Helsinki Stock Exchange has been one of the best places to invest in the long run. The left-hand side, you can see the total return of Helsinki Stock Exchange in the last 106 years, the amount Finland has been independent. The compounded annual growth of the stock exchange, including dividends and adjusted for inflation, has been 5.8%, which is top 10 in the world. For example, US stocks have provided a return of around 6 to 7%, so it's quite near that. Of course, not in a cumulative sense, but in any case. On the right-hand side, you can see the last 30-year returns yearly, and as you can see, it's very uncommon to see a normal year of returns of 6 or 8%. Sometimes it's minus 56, and sometimes it has been even plus 162% in the internet bubble 1999. This is our stock exchange at a glance. In the left-hand side, you can see that they have a net income of around 20 billion euros. This only consists of companies that Inderes analyzes, but we have 155 companies we analyze. That's almost the whole stock exchange. There's not many big companies we are not analyzing, so you could almost say this is the whole stock exchange. The market cap is 250 billion. So that means that you have to pay around 13 times estimated earnings this year if you want exposure to Helsinki Stock Exchange. And as I said earlier, dividend yield of over 5% and return on equity almost 13%. Nordea is our national treasure. If you look on the right-hand side, net income by company. Nordea is the biggest. It's 1/4 of all the earnings. Then comes Neste and Nokia, Sampo, Kone and Fortum. And the rest of the companies, 150 companies, they make around 7 billion euros. If we look at different sectors, there are so many that I won't go through all of them, but I would say that banking is a huge sector because of Nordea. Of course, we have a few other banks as well, but they're a lot smaller. You can get exposure to renewables and biofuels through Neste. Then we have a lot of machineries or industrial services and manufacturers like the elevator company Kone, or if you want ship engines, then Wärtsilä or Metso and so on and so on. So we have a lot of industrial companies. The forest sector is well known in Finland, but it's not actually that big anymore. UPM is very valuable, and in total those are around 30 billion euros, so a bit more than 10% of the whole market cap of the whole stock exchange. We also have some smaller, very interesting sectors like IT services or, for example, wealth management, that they have structural good growth and they are not very capital intensive businesses, or at least most of them are not very capital intensive. Or maybe one of the most popular stocks in recent times has been Kempower from Lahti, which manufactures and develops EV chargers. So that's a very interesting company as well to study more. And I also have to mention, of course, Sampo, which owns If, which is perhaps one of the best insurance businesses in the whole world. So we have some interesting companies, even though we have some headwinds as well, especially with Nokia, but as you can see, Nokia is not that big anymore these days. If you want to have multi-backers in your portfolio, I recommend to look at small caps. This is an interesting study that studied 50,000 companies in the last 10 years. Only 446 had a total return of plus 1,000%, so they grew 11 times or more, and most of them were nano caps in the beginning, so they had a market cap of less than $50 million, or micro caps, so $50 to $300 million. So if you want to have small multi-baggers in your portfolio, I recommend to look at those small companies especially. If you buy large caps, it's much more uncommon to see them multi-bag, at least in 10 years. As I hinted earlier, the global market, not Helsinki Stock Exchange, but globally stocks have probably bottomed last autumn at the same time when inflation peaked. And it's not a coincidence because we've also seen interest rates stabilize since last September. In this picture you can see the whole world stock exchange index, and on the other hand, the United States 10-year bond yield. It went to 5% eventually, but now it has actually come down to 4.3 or 4.4% again. So as you can see, stock bottom at the same time as interest rates saw their peak. Be aware of recessions though, they are rarely priced in. This is an interesting graph from the Bank of America research team where you can see S&P 500 max drawdown during recessions and max drawdown during recessions, but 6 months prior to the recession. And as you can see, even though we usually think that investors anticipate what comes in the future, but they are not that good forecasters. If or when recession hits, it will be felt in the in stocks and in equities in general. Valuation difference has widened between US and Europe. There's of course very good reasons for this, but I think Europe is quite interesting place now to look for interesting opportunities, even though of course United States has wonderful companies, the Magnificent Seven, as I told you in the beginning, but also Europe has some good companies, and you only have to pay 12 times their earnings at this point. But as I said, there are some good reasons for the valuation difference, like return on equity. As you can see here, they both enjoyed a return on equity of around 15% before the financial crisis, but after the crisis, Europe has seen only lackluster level of profitability in terms of return on equity. But on the other hand, in the United States, their return on equity is now at almost all-time high. And I think this is because in Europe, we have had more banks which have been in big trouble because of zero interest rate environment. And also we have a lot more big industrial companies. On the other hand, in the United States, they've had higher interest rates, so banks have performed better. And also they have those super big mega technology companies that can grow in almost every possible economic environment. But it will be interesting to see in the future if competition and capitalism work, should these levels converge sometimes in the future? And also if interest rates stay higher in Europe in the future, maybe we see higher return on equity in Europe as well, because banks can maintain higher profitability levels. Talking about earnings growth, one reason why US stocks have done so much better in the last 15 years is of course that we have seen earnings growth in the US, but not too much in the rest of the world. It's also interesting that in China, their earnings peaked around 2014, and they've been decreasing actually ever since. And now Europe, which is a very slow-growing economic environment, European earnings are actually catching up with Chinese earnings. But if you look at those valuation differences, return on equity and slow earnings growth, that explains some of the difference between US and Europe and US and the rest of the world as well. Actually, if you look at the rest of the world without USA, the earnings level are still below the level it was before the financial crisis, which is quite shocking since it's been now 15 years since the crisis. Just to remind, I know many viewers here are smart and know already these things, but usually earnings drive equity returns in the very long run, I mean, and economic growth drives earnings. Here you can see on the left-hand side S&P 500 earnings per share. They were at 1960, it was $3.1, and now it's around 2020 or was last year. So the annual growth nominally has been 7.1%. And actually, it's not a coincidence that the index has also returned 7.1% per year since for the last 63 years. That's excluding dividends. With dividends, it's actually 10%. And on the right-hand side, you can see US nominal, not real, nominal GDP growth, and that has been 6.4%. So it's almost the same as the annual growth of earnings. The difference can be explained by that US companies, they operate globally, of course, and they also buy back their shares, so that can enhance earnings per share over time. But it's interesting just to remind you that in the long run, when the economy grows, the earnings can grow as well. Lastly, very important reminder, price is what you pay and value is what you get. Price is a different thing than value. Try to get value at good price. Thanks for your interest, and now I'd like to welcome to the stage the next company presenting will be Realize.